Hello. Okay, here we are. Today what we're going to do is we're going to go over our homework from Chapter 9. There's a few loose ends I want to wrap up from Chapter 9. And then I want to, we're going to eventually today probably just start Chapter 10. Now, let me give you an idea where we are. We're going to have this lecture, another lecture, and then another lecture. So counting this lecture, 3 more lectures, and then it's time to take the test. Okay? So you've got this lecture and 2 more lectures, a total of 3 lectures, counting this one, and then it's going to be time to take the next test. And the next test will be over Chapter 8, 9, and the first part of 10. Not the entire Chapter 10. Just 8, 9, and the first part of 10. And I'll give you a study guide so you're very clear as far as what's going to be on the test. But I want you to start, preparing yourself for that. Cool? Okay, let's go ahead and go to the homework. Did you guys do it? Good. Because you're not going to learn this stuff unless you do your homework, okay? So let's take a look at exercise 9.4, I believe is the first one. Exercise 9.4. All right, now this is going to be a percentage of sales situation, isn't it? And I think there's a write-off in it as well. Okay. All right. At year end, December 31, Alvair Company estimates its bad debts as 0.5% of its annual credit sales of $875,000. Alvair records its bad debt expense for that estimate. Okay? Okay, let's go ahead and do that. I know what they're going to ask us to do, so let's just go ahead and kind of do this as we're reading through it. All right? So, when it's a percentage of sales method, we do not have to do the T-account analysis, do we? We only have to do, we just take that percentage times sales or credit sales. We get the amount, and that's what goes in our journal entry. Are you with me? Okay. So we have done that numerous times, haven't we? Okay, is that what y'all got? Okay, good. Now let's go ahead and read on. On the following February, Alvair decides that the 420 account of P. Cobble is uncollectible and writes it off as bad debt. Okay? What is that entry? Well, under the allowance method, when we write off an account, we debit the allowance account and we credit accounts receivable for P. Cobble. Now, we know that we have to record that in the customer subsidiary detail, don't we? Okay? Now, I've said the following before, but I'm going to say it again. When we, under the allowance method, when we estimate bad debt expense, this is the journal entry. When we write off an account, this is the journal entry. I'm going to ask you to do both on the test, and students always get mixed up, which I'm asking. So I can't be any more clear, can I? This is estimating a bad debt expense. This is writing off a specific account. Okay? Now, in this particular example, let me point out one more thing. Let me point out one more thing before we go on. See how we are debiting allowance for doubtful accounts and crediting AR when we write off an account? I should have said this the last lecture, but that's how the allowance for doubtful accounts can get a debit balance. Okay? Remember when we're doing percentage of AR method, which we'll do in a minute? Remember how sometimes the allowance for doubtful accounts has a credit balance and sometimes it has a debit balance? Well, it can have a debit balance because this is when the account is debited. Okay? If we've been writing off more accounts, specific accounts, than we were estimating bad debt expense, then your allowance will have a debit balance. Make sense? Okay? All right, well, in this particular example, though, what happens then on June the 5th? Cobble comes in and unexpectedly pays the amount written off previously. So all we do is we reverse that entry. This is just a flip-flop of that entry. We reverse it, and then we collect the cash as we would on any other receivable. Are you with me? Cool? Okay, y'all get that? Okay, let's go to the next one then. Let's go to the next one. And the next one is exercise 9.5. Now this is a percentage of receivable method, isn't it? Okay. At each calendar year end, Kabul Supply Company uses the percent of AR method to estimate bad debts. On December 31 of 2011, it has outstanding accounts receivable of $53,000, and it estimates that 4% will be uncollectible. Prepare the adjusting entry to record bad debt expense for the year 2011 under the assumption that allowance for doubtful accounts has a $915 credit balance before the adjustment. Okay? All right, let's go ahead and do that. Okay? All right. Well, the first thing that we have to do is take our, what's our receivable amount? Yes, and we're going to estimate 4% times 53,000, which what does that equal? 2120. Pardon me. Okay, we'll edit that out, don't worry. Okay? Now, is that the amount of change that we make? No. That is what we want the ending balance to be in our allowance for doubtful accounts. But it has a beginning balance, does it not? Okay? It has a beginning balance. What is the beginning balance? 915. So what does our adjustment have to be? 1205. And that, back that up a little bit. That is this is our adjusting journal entry, isn't it? Okay? First we had to figure out what the desired ending balance was, and then once we had that, we know what our adjustment needs to be, correct? Okay. Make sense? Did y'all get that? Okay. Question?
Why didn't you add the 1332? Or is that a different part? Oh, never mind.
Yeah, I think is that the next part?
Yeah.
Yeah. And these are completely independent of each other.
Okay.
Okay? Okay, so we know, let's do part B now. Okay? Part B says that what if it has a 1332 debit balance before adjustment? Okay, we still know that 4% of accounts receivable is 2120, and that is what we want the ending balance to be, correct? But it has a beginning balance of what? 1332 to the debit? And we talked about how an allowance for doubtful accounts could have a debit balance. Because when we write off specific accounts, we are debiting allowance for doubtful accounts. So what do we have to do to this thing to bring the existing debit balance of 1332 to a desired ending balance of 2120? Is it 3452?
Yep.
Okay. That is our entry then, right? Cool? This is our journal entry to estimate bad debt expense, and this is the percentage of AR method. You think I'm going to ask you to do this on the test?
Yeah.
Yes.
No, I am. Sarah's shaking her head. No, I won't. Yes, I'm going to. I'm going to ask this on a test to clarify. Cool? All right. Questions on that, folks? Okay, let's do exercise 9.6. Exercise 9.6 is an aging of AR method. Okay? Aging of AR method. Just a little refresher here. Let's go to the PowerPoint and remind ourselves what the aging of accounts receivable method is. This is where we say we're not just going to take a percentage times the total balance of AR, but we're going to group it into categories as far as how long it is past its due date. And then we're going to multiply each one of those groupings times a bad debt percentage, recognizing that the older an account is, or the more time that has elapsed since its due date, probably the less likely we're going to collect that amount, right? And then you can see the next slide. They break this down and they apply a percent of collectible. Now let me point out one thing here. These amounts right here, somebody goes, well, where do you always use these percentages? You know, 1, 3, 7, 40, 60? No. This is just what this particular company, Barton Company, decided to use from past history. Okay? These are estimates. Okay? And I believe that the example we're going to do now, they used different numbers, didn't they? Okay? So don't be confused with that. That's just their estimate. Okay? Now once we have that estimated collectible amount for each category, then we add them up, and that is what we want to be the ending balance of our allowance for doubtful accounts, correct? And we have to adjust accordingly. All right? So let's go ahead and take a look at exercise 9.6. Okay. Hector Company estimates uncollectible accounts using the following allowance method at December 31. It prepared the following aging of receivables analysis. And they give us the accounts receivable as in total 190, but they break it down into days past due, right? 132, 30, 12, 6, and 10. The sum of those 5 numbers equals 190. And then they tell you the percent uncollectible, and this is just from past experience. Okay? Now they want to estimate the balance of allowance for doubtful accounts using the aging of receivables method. All right? So what we're going to get here is they are estimating that it will have a 40-20 credit balance. Correct? You with me? Did you guys get that? Okay. So now let's do part B. What is the adjusting entry to record bad debt expense using the estimate for part A? Assume that there's a beginning balance in the allowance for doubtful accounts of 600 credit. Well, if it's got a 600 credit, and we need to have a 40-20 credit, then what do we have to do? We have to do that, right? Correct? Do I need to do the T account here? Or are you good? Okay, same rationale. We look at what the beginning balance is. We look at what the desired ending balance is. And the adjustment we need is 3420 to bring that beginning balance to the desired ending balance. Okay? Part C says, what if it has a 400 debit balance? Well, if it has a beginning balance of 400 debit and we desire a 40-20 credit, then we have to make our entry for 44-20. Right? Percentage of receivable methods. You have to do your T account. I didn't do them here. I didn't do it here because hopefully you're starting to know how to do it by now, right? We've done a lot of these at this point. Okay? Now, people always get confused on the test. They start doing T accounts for percentage of sales methods and not doing them for percentage of receivables methods. Remember, percentage of sales, simple sales. You don't have to do the T account. Percentage of receivable methods, you have to do the T account and figure out what it'll take to take the beginning balance to the desired ending balance. Okay? Are you feeling good about these? Okay. I definitely will have this on a test, so I want you to. All right. Our next one that I assigned, I believe, was 9/11. Exercise 9/11. So let's take a look at that, all right? Okay. Now, we talked when we spoke about notes receivable last lecture, we talked about how notes receivables are a little bit more formal. They're written on a note. There's usually interest involved, right? And I think the example we had in our slides was when somebody sold something on notes receivable, right? You debited notes receivable and you credited sales. Remember that? This is another time that you might see a notes receivable in a business, another example. Here's what we had on exercise 9/11. On November 1st, we accepted a $5,000, $180 6% note dated November 1st from Melissa Allen and granting a time extension on her past due notes receivable. So in this situation, this individual owes us $5,000 on accounts receivable. But maybe she called us and said, hey, the economy is pretty tight right now. Can we arrange some sort of payment or something? Some sort of payment plan because I'm really having trouble paying this. Now, for those of you who have done collections, Kim, didn't you say you've done collections? If somebody calls you or you talk to them, they're honest with you and they say, hey, I'm having trouble paying it. Can we somehow set up a payment plan? Have anybody do that? And if they abide by that payment plan, you're fine, aren't you? You're okay. They're not your concern. They're not your stress. Your stress is the people who won't call you back, or they set up a payment plan and they don't abide by it, right? Okay? But if you guys are ever owe somebody money, the best thing to do is not turn your cell phone off and throw your mail away without reading it. It's to be honest with them and say, hey, I know I owe you some money. Cash is a little short. Can we figure out something here? I want to make whole on this thing, but I need to have some help here. Okay? And that's what this situation was. This person said, I need a time extension on the $5,000 I owe you. So what we do is we take the accounts receivable off the books. And we set it up as a note receivable. And we might have her come in and sign a little something. And we're going to charge her a little interest, right? A little bit of interest. Okay? So that's what happens on November 1st. Now on December 31st, we need to accrue some interest that we have earned on this, right? We've earned some interest. We're not going to get paid this day, but we need to accrue some interest, okay? So, how much interest have we earned as of year end? Well, we have earned $50. And the way we got that is we take the principal of $5,000 times the annual interest rate of 6% times 60 over 360. Because 60 days have passed between November 1st and December 31st. So there's no cash being debited here. We're not receiving any interest, but we have to show on the financial statements that we have earned revenue, interest revenue of $50, and that we are due. We have a receivable for interest receivable of $50. Now notice this is not debiting notes receivable. This is debiting interest receivable. Okay? You guys checking with me? Okay? Make sense? All right. Now, then Alan honors her note when presented for payment. Okay? All right, now here's how I kind of walk through this. Here's the way I do this entry for November or for April 30th. Okay, here's how I do it. First of all, I ask myself, what is the total amount of money I am going to receive from this person? The total amount of cash I'm going to receive. Well, I know that I'm going to receive $5,000 for the principal, right? But I'm also going to receive some interest, correct? How much total interest will I receive? Well, I'm going to receive $5,000 times 6% times, and this is a what note? A 180-day note. Is that correct? So take it divided by 360. Again, we use the 360 as opposed to 365 just so the math is a little cleaner. And I believe that equals $150. Is that correct? That will be the total interest I receive. And I'm going to get principal of $5,000 plus interest of $150. Okay? So, now let's build our journal entry. Well, like I said, I'm going to get cash of $51.50, right? Now, I'm going to reduce my notes receivable for $5,000 because it is now honored, correct? Now, how much of that $150 total interest revenue has not yet been recorded as interest revenue? $100, correct? Now, that journal entry doesn't balance. It's $50 short, correct? So what do we have to do? We have to reduce interest receivable by $50 from up here because that has now been received. Make sense? Okay. Questions on that? All right. Had a student in another class that asked me a really good question. And what she said is, well, we've learned about allowance accounts, allowance for doubtful accounts for accounts receivable. Would you ever have allowance for doubtful accounts for notes receivable? It's a good question. Real good question. My answer would be this. Yes, you probably would, especially if you had a lot of notes receivables. We're not going to really apply the allowance for doubtful accounts analysis to notes receivable in this class. It would be exactly the same. Exactly the same. But yeah, notes receivable, you probably would have to have some sort of estimate of bad debt expense, especially if you had them, a lot. Okay? Certainly a bank has a lot of notes receivables on its books, right? And certainly it has an allowance account. But we'll mainly just use the allowance and the estimate of bad debt expense towards accounts receivable, not notes receivable. Okay? All right, let's go through our last one, which I believe was exercise 9:15. Is that correct? Now, I wanted you to read about this ratio in your books, and just going to the PowerPoints real quick. This was the accounts receivable turnover, right? Now, we had a similar ratio in chapter 8, I believe, with day sales uncollected. But the accounts receivable turnover is an extremely important ratio. It's how quickly your receivables are turning over. Remember when we talked about inventory turnover? We talked about how you want your inventory to turn over, right? Well, you want your receivables to turn over. You want to collect them, right? You want those receivables to come in. One of the most important ratios that when I go look at clients' books is I figure out this account receivable turnover for them. I trend it over time, like figure it up on a monthly basis for the last 2 or 3 years. And I ask myself, are their receivables speeding up or are they slowing down? If they're slowing down, that can usually mean people aren't paying as quickly, which usually is going to indicate some sort of cash flow challenge. You with me? So accounts receivable turnover is a very important ratio. Okay? Now, let's take a look at exercise 9:15 in particular. Now, they tell us that the following information is from the financial statements of Wasim Company. Compute its accounts receivable turnover for both 2010 and 2011. Compare the two-year results and give a possible explanation for any change. And they tell us that the competitors average a turnover of 11. Okay? Okay. Well, let's go ahead and first just calculate those ratios. Okay? See what they are. So take a look at that. For 2010, it was 12.4 times. And for 2011, it was 14.0 times, right? Did you get that? Now, one thing you have to be careful. Sometimes people will say, I set this up, but I got a different number when I put it into my calculator. Did anybody have that happen? You got to pay real careful attention to your order of operations here on your calculator. If you just say 236,000 divided by 20,700 plus 17,400 divided by 2, and that's the way you enter it into your calculator, you're going to get an incorrect answer. You have to pay attention to your order of operations. You have to add these two together first, then divide it by 2 to figure out what your average is, and then take the numerator divided by that. So be careful with that, okay? Did anybody have that mess up the first time they did it? Okay, good. Okay, well, are things getting better or are they getting worse? They're getting better. Receivables are coming in quicker, and relative to their competitors, let me back that up a little bit. Relative to their competitors, they're doing pretty well also, aren't they? Okay. So, you know, we don't have a ton of information here, but we do know that it improved from 12.4 times to 14.0 times, and that both of those amounts are higher than their competitors. Okay? So that's good. All right. Questions on that?
So that was the previous year and then the current year, and you divide by 2?
You mean when you're calculating it?
Yes.
The average accounts receivable.
Yeah. Here's what you want to. Here's the way I always want to think about it. Is when you take a sales amount, like if you are taking sales for 2011, then you are taking sales from, you know, January 1 of 11 to 12/31 of 11, correct? So you have to divide that by, the AR at that point right there and the AR at that point right there. Does that make sense? And of course your January 1/11 AR balance would be the same thing as December 31 of 10. But you can't take sales for the whole period and then just take your receivables at one amount. Okay? You have to, you know, this is kind of like the bookends for that sales. Does that help? Mm-hmm. Okay? All right. Okay, there's one last thing I want to talk about in chapter 9. And in your textbook, it's actually at the beginning of the chapter. But I like to put it off until the last part of the chapter. And it's in regards to credit card sales. Okay? Credit card sales. The reason I like to put this off is because I think it makes more sense to talk about regular accounts receivables and then talk about how we deal with credit cards. Okay? Does anybody work at a retail place that accepts credit cards? Okay. Cassie?
Well, I work at a hotel.
You work at a hotel? Okay. Anybody else?
I have.
Where?
At Wild Oats.
Wild Oats.
And Whole Foods.
Okay. And Whole Foods. Okay.
I work at a chiropractic clinic.
Okay. Most places take credit cards. Now, okay, first of all, make sure you understand, too, I'm not talking about debit cards here. I'm not talking about debit cards. I'm talking about credit cards. Does Best Buy accept credit cards? Of course they do, right? Now, why does a company use credit cards? Because you're going to find out they have to pay a fee. They have to pay a fee on these credit cards. For example, and let's ignore sales tax for right now. Okay, if I buy a $1,000 TV from Best Buy and I use cash and there's no sales tax, they get $1,000. If I buy that using a credit card, you're going to find they don't get, in the end, they do not get $1,000. They get less than that. So they actually, all things being equal, they wish I'd pay in cash because they're going to get more money. but they allow me to pay in credit cards. What are some reasons that companies use credit cards? Let's go to the PowerPoint. What are some advantages of letting companies use credit cards? Well, people say interest charges. And let's come off that again. I apologize. Let's come off that. People say they interest charges. I don't want to say that's a reason. It might be a secondary reason, but they're hoping you pay your balance. Okay? They're hoping you pay your balance.
But even if you don't pay your balance, like they already got their money. So the amount of revenue that it creates probably is more than the fee they have to pay for using that specific credit card.
Compare that with a regular accounts receivable. Because when you pay with a credit card and the credit card runs through and is accepted, they're good. Best Buy does not need to worry about you when you bought that big screen TV on your Visa credit card. If you decide to stick it to somebody, who's going to get stuck? Visa. They don't have to worry about you. They don't have to evaluate your creditworthiness. They don't have to hope and pray that you pay. They don't have to worry about collections. They have their money. Yes, it's a little smaller amount than if you'd have paid in cash, but they have their money. Okay? They don't have to go through that whole hassle. Okay? They also get their cash sooner, right? Okay? Other reasons.
Strengthens your internal control.
I could see under some situations where maybe it could strengthen your internal control because you don't have as much cash coming on. That's probably not a primary reason, but it could be a secondary one.
To increase sales.
Yeah, and the biggest part here is, what if Best Buy or Nebraska Furniture Mart said, you know, we're tired of paying these credit card fees. We'd rather you pay in cash because we get more money. So from now on, we're only going to sell our wonderful products at Best Buy or Nebraska Furniture Mart only with cash, no more credit cards. They'd go out of business. They would go out of business. Okay? I'm not going to do it, but if I went to Nebraska Furniture Mart and looked at how many people are paying with their credit card, they're going to pay this off later, it would probably be a pretty high number, right? Probably be a pretty high number. Because we live in a country where it's buy now, pay later, right? I want it now. I want it now. I don't want to wait. I need it now. I'll worry about my payments on the credit card later. I know I want a big screen TV now. And if you watch commercials, they kind of pray. They go, you deserve this, don't you? You deserve this. Okay? So, these are good reasons that you've given me. Now to the PowerPoint. As I said, they kind of summarize what we've been talking about, the advantages. Customer's credit is evaluated by the credit card issuer, not the retailer. Okay? It provides a purchase option to the customer, so there's more sales. You don't have a risk there. You don't have to worry about the customer not paying you, and you get your cash quicker, right? Now, how does this look? This is pretty easy. And they have this three-point explanation here, but I think you're going to find when we do an example, it's pretty simple. Okay, with bank credit card, there's two types of credit cards. Either you get the cash right away, or you collect your receipts, submit them to the credit card company, and you get paid a little later. Okay? Let's just look at an example. What if on July 16, 2012, Barton Company has a bank credit card sale of $500 to a customer? The bank charges a processing fee of $2. This is a bank credit card. The cash is received immediately. Well, you're going to book your sale of $500, but you're not going to get cash of $500, are you? You're going to get only 98%, which is the 100% minus the 2% fee. 98% of $500 means you'll get cash of $490. And then the other $10 is going to be charged to credit card expense. You see how that works? So, what about in a situation where you have a bank credit card sale of $500, and the bank charges a processing fee of 2%. However, they don't get their cash right away. They have to remit the credit card sale to the credit card company and wait for payment a few days later. Well, everything is the same, except in that first entry, you don't debit cash. You debit accounts receivable from the credit card company, not from the customer. We're good with the customer. They're done. We don't. That's not an accounts receivable from the customer, but rather the credit card company. And then on July 28th, the credit card company gives us our cash of $490, and we decrease the receivable we have from the credit card company. You with me? Okay? Yes?
Do you make a journal entry for the transaction with the customer? Or is that just going...
Between the customer and the credit card company? Or...
I mean, like, how do you log that you made that transaction with the customer? Like, you say that you have the money and you're good with them, but, like, do you just have to
let's just take a look
document
at
the
it.
receipts?
Let's take a look at the previous journal entry. This is it. I mean, we're recording this. I mean, let's say this was a cash sale and not a credit card company. We would debit cash for $500 and credit sales for $500. That's recording the sale, right?
Okay.
Here, everything's the same except it's a credit card. We get the cash immediately of $490, and the $10 less that we don't get is just a credit card expense. So that entry and these two entries, or the top entry on the screen, the top entry, is recording the transaction with the customer. Okay? Because there's no receivable from the customer, is there? There's no, in any of these, there's no accounts receivable from the customer. That's why I put it at the end of accounts receivables. Because the credit cards are not classic accounts receivables, are they? Okay? There may be something you want to do so you don't have to worry about bad debt expense. Of course, you're going to get a little less money. You have to pay the credit card fees, right? Okay? So I'm not sure if that answered your question or not, Sarah.
No, it did. I saw in the first one you just, like, recorded as cash.
Yes. Yes.
It's not like
We
card revenue
recorded
or
this
something.
cash and we booked the sale. We booked the revenue. Okay? Mm-hmm. All right. And you can read a little bit more in your book about that. They've got some good examples there. And I think I will assign one, okay, for you to do for homework. Okay?
Is it the same reasoning for, like, you know, companies offer the buy now, pay 12 months later? Because you don't need a credit card for that.
Yeah, and that's kind of when they say buy now, pay later, that's a little bit of an accounts receivable situation, isn't it?
There's always a fee on that too.
Yeah, there is.
Even if you pay early.
And, you know, and there's a lot of different complications that come into play that I don't want to go too far down, because some companies will maintain a pure accounts receivable sort of situation, buy now and pay later. And some will do it with no interest. A lot of them will immediately sell their receivables to somebody else or to a credit card company. That's one slide. I'm glad you said that, Matt. Let me go back to and show you one slide that I forgot to talk about, and that's this. Companies sometimes decide to dispose of their receivables or sell them, or sometimes we call factoring them. Okay? Companies sometimes do that. I want you to be aware of that. Let's look at an example coming off the PowerPoint. Let's say, Matt, that you owe my company $1,000, okay? And it's due in 30 days. You owe me $1,000, it's payable in 30 days. Here's the problem, though. I need the money now. I need the money now. So what I could maybe do is sell the receivable to Jake. And here's what he does. He pays me $965 for that receivable. So I have my $965 today, which I needed cash today. And now you have a $1,000 receivable from Matt. So you make the $35 providing he pays. That's called you selling a receivable.
And would that be just like an accountant firm? Or?
Well, that could be, there are companies who this is what their business is. They buy receivables. Now, have you ever seen those fast cash now places? Those places are, if you're ever in one of those places, you know things aren't going the way you maybe would like. Because those places are like rip-offs. Because what they'll do is they'll say, okay, you need money now, and you get paid in 2 weeks, and you're going to get your $2,000 paycheck, but you need money now. So what they'll do is, it's kind of the same situation. They'll give you cash now, not $2,000, but maybe $1,900, and you get paid today, and then when you get paid from your employer, who gets that money? I do. Well, when you figure up that interest rate, it's unbelievable. Because basically you paid a $100 fee to get your paycheck 2 weeks earlier. And if you would figure that up on an annual basis, it's really exorbitant. Okay? They're not loan sharks, but they're close to it. Okay? You're not going to find the brightest and best financial minds going into those places and getting paid early. Okay? You're not going to do that. So that kind of answers your question, doesn't it? Mm-hmm. Different ways that you can handle those things. All right? Good. Okay, we are just going to dip our toe into chapter 10. And does everybody have the chapter 10 PowerPoints? You hand those to Allie. For you folks at home, you can pull these off of the Angel, as always. We're not going to talk a whole lot about receivables, but we have a little bit of time, so let's just talk a little bit about them, okay? I might have said that wrong. Chapter 10 is fixed assets, not receivables, if I said that wrong. Chapter 10 is plant assets, natural resources, and intangibles. It's kind of a long chapter, and again, we're just going to go through the first part, which is what will be on your test over 8, 9, and the first part of 10. What are plant assets? Plant assets are things like buildings and forklifts and a conveyor belt and land and equipment and an automobile, a truck. These things are tangible in nature, which means you can touch them. Now we're talking about plant assets right now. They are tangible. You can touch them. You can feel them. They are actively used in your operations. You need them to conduct business. Now, they don't just benefit one period. They benefit a number of periods. Like if you buy a tractor for your landscaping business, you can touch it, it's used in your operations, and it's going to provide benefits for a number of periods, isn't it? Sometimes we call plant assets property, plant, and equipment, or PP&E. You'll sometimes see the abbreviation PP&E. Okay? That's what we're going to talk about in this chapter. Now, just like people are born, and then they have all sorts of events in their life, and then they eventually die, right? Well, plant assets are the same. We're going to account for when we acquire them. That's analogous to when they are born. So we're going to compute the cost of when we acquire them. And then there's things that happen while we have the asset, okay? Such as allocating the expense to the benefits or to the periods benefited. And what about subsequent expenditures? What happens if you get, a partial repair on your car or something? And then eventually we're going to account for when you dispose of the asset, either by selling it in or trading it in or selling it or just throwing it in the trash. But we're going to account for all these things that happen during an asset's useful life, okay? Now, one thing about an asset is when you acquire a fixed asset, all expenditures that are needed to prepare it for its intended use will be included into the cost of the asset, okay? Let me give you an example. Let's say you go over to JCCC Food Services, and let's say one of the little restaurants there, they buy a dishwasher, okay? They buy a mechanical dishwasher, okay? Now, the cost of that dishwasher is $3,000, okay? Now, they have to have it shipped to them, and it costs $200 to have it shipped, okay? And when they have it shipped, they buy insurance on it, so if it's damaged, they won't, lose out. And so their insurance is $50 on that, Now, when they receive that dishwasher, they have to pay somebody to unpack it, put it together, and install it and test it. Okay? So the installation and testing, let's say that's $300. Okay? Well, when they record that dishwasher on the books, they're going to record it at 3,550. That is the cost. And that's how much we'll eventually depreciate. Because all of these costs were necessary and reasonable in acquiring that fixed asset. Make sense? Okay? This is something you'll see consistent through accounting, is this sort of treatment. Okay? Now, for machinery and equipment, this could include things like purchase price, taxes, insurance, installation, like I said. For buildings, this could include title fees, attorney fees, brokerage fees. Of course, if you're constructing a building, all the costs of construction you'll keep track of. If this is land, you could have surveying fees, real estate commissions, title search. Okay? Remember, we talked about this, I believe, in chapter 3, but remember, we don't depreciate land, do we? Land is not depreciable. Okay? Now, there is something called land improvements, and I put some pictures on this slide. Land improvements is not just pure acreage. This is like when we put a parking lot or fences or shrubs or lighting systems or sprinkler systems, those sort of things. Those are called land improvements. We do depreciate the land improvements, okay? But not the land. You with me? Let me kind of give you a little example real quick. Going over to the Elmo again. Okay, let's say that I pay $1 million for some land. This is land down in Paola or something like this, okay? And this is just land. You know, bunny rabbits running around on it, tumbleweeds blowing by, all that sort of stuff. Okay? Then let's say I pay $150,000 to improve that land. And I put on a parking lot, and I put some street lights or some lights for the parking lot and all that sort of stuff. Okay? Well, these are going to be listed separately on my books, and I will depreciate the land improvements, but not the land. Make sense? Okay? So land improvements are depreciated, land is not. And we're going to talk about depreciation next chapter, or next lecture, I should say. Not next chapter, next lecture. So we're going to stop right here with land improvements, okay? And so let me give you what your homework is for next period, and then we will move on. Pardon me?
If you were to build a property, that wouldn't come into that, right? It wouldn't be depreciated.
If you built a building?
Yeah, or it would.
Yeah.
It would.
Yeah. If you build a building, it's definitely depreciated.
But is that a land improvement, or is that just...
No, that's a building. Land improvement is, like I said, you put a walkway on some land or shrubs or parking lot or something like that. Okay? All right, let me look here real quick as far as what I want you to do. I don't think you're going to have a whole lot of homework tonight. Okay. But let's go ahead. Here's all I want you to do. These are both quick studies. I listed them separately because one's from chapter 9 and one's from chapter 10. So I want you to do quick study 9.1 and quick study 10.1. I only listed these under separate headings because they're different chapters. Okay? Quick study 9.1, quick study 10.1. Cool? See you guys.